It's official. The IRD has entered its villain era. They've got debt collectors on speed dial, court orders in their back pocket. And if you owe tax, you might be getting a call. Dan Lowe, partner, property and construction lead at Grant Thornton, is here to break down what it means for your wallet, your reputation, and your rights.
Financial freedom faster. Financial freedom faster.
Last week, more people watched this channel than all the other New Zealand property and investment shows combined. We are your unfair advantage in New Zealand property. Serve daily, no apologies. Subscribe and get ahead. Dan, who is the IRD targeting?
Well, it's a pretty broad group, if I'm honest, Andrew. So the IRD, I guess, for the last 5 years has been a little bit of a sleeping giant. Clearly, when we had COVID, there was a lot of businesses and taxpayers that were struggling, and the revenue were given the mandate to take it easy and to allow probably a little bit of slippage. And where we're at right now is that the government needs some money. And so they have been, IRD has been re-engaged, starting to police old debt, poor compliance, hidden transactions. So at the moment, there is a lot of focus on property construction, particularly in what they call the hidden economy, cash jobs. Crypto is starting to get up there as well. And just generally looking to collect tax that has been not paid over those last few years.
Dan, let's look at the IRD's targets entity by entity. My understanding is they've got $116 million of funding to be spread over the next 4 years, $29 million a year to chase people that are behind on their tax obligations. Looking at private people that pay tax on their own account, how do we get ourselves in a position to avoid audit or to get things in order?
I mean, I guess the best thing that you can do as a taxpayer is quite simply to stay on top of your compliance. Because if you're filing on time, paying on time, you'll stay under the radar. You'll be of little interest from the revenue's perspective, unless there's a large transaction that is happening. Where you can invite, I guess, the devil into your doorstep is, when you are slow in paying, not communicating, and just a little bit of a delinquent with that compliance piece. So the best thing that you can do to keep IRD away is stay on top of that stuff.
And what about as a business? Is it very important to engage proactive accounting or log into IRD website yourself? Like, how can you as a business avoid auditors coming and knocking on the door?
Well, look, I mean, sometimes it's a little bit random. It certainly used to be way back in the day. So you could, on average, expect IRD to have some involvement in your business maybe once every 4 years. That was an average, and that was a scattergun approach from the IRD. Now they've got access to big data. They're a lot more structured with how they spend their audit resource, and they're a lot more focused. So an easy example, I guess, in the property space is that when the bright line tests were introduced, they just married up records with LINs, and were able to check that off and say, hey, we see that you've acquired and sold a property within the bright line timeframes, but we don't appear to see anything in your income tax return. Can you talk to us about that?
And what about with these rule changes with regards to trusts? There's been some nuances over the last few years, change in government, change in policy. People are trying to structure things in different ways to get around this 39% rule.
Yeah. I mean, that's obviously very topical. It's a big jump, and it's different from what we've known for a long, long time. So for forever and a day, trust tax rate was 33 cents if it was retained in the trust. So it was a pretty easy way of navigating the 39% personal tax rate if you're operating through a business, having dividends roll into your trust and just not paying any more than 33 cents. So that change of trust tax rate, which has been retained by the current government at 39, makes it a little less palatable for people to structure via trusts. Doesn't mean that it's the end of trusts. I think they still have their purpose. But what people that are listening in may have seen happen last year was that there was a flurry of dividends that were rolling out of companies to their trust shareholders, maximising what they could push out at 33 cents. So certainly in our client base, That was the behaviour that we saw. So they were just paying a withholding tax, moving it from the company tax rate of 28 to the trust tax rate of 33, pushing out all they could, so that they've got current accounts to draw upon going forward. But on a proactive, looking ahead perspective, yeah, it's a challenge, because people naturally want to manage their tax exposure. They can do that by distributing to beneficiaries that have a lower marginal tax rate. So if you have kids that are over 16, they actually become useful. So you can push money towards them, and as a family unit, you can have a lower tax outcome. It does, of course, mean that the trust owes those beneficiaries that money at some future point in time. So it's not completely one-sided, but it does allow a bit of income splitting amongst the family unit.
A reminder, money's not polite. It moves fast. And the people subscribe to this channel, they're already running past you. Thinking about it won't save you. Subscribing might. The property investors are coming even more under the microscope. Is it mainly the mum and dad property investors with 2 or 3 properties, or property developers, or a bit of both?
I think mum and dad property investors are probably largely under the radar. There's been changes, no shortage of changes in that space. The bright line test has been introduced. The interest rate restriction that was introduced is now kind of coming off, but there are still restrictions around using rental property losses against other income. So that's kind of disadvantageous from what it used to be. Depreciation's been removed for quite some time off the building, both in residential, and now it's been reintroduced for commercial too. So there is no depreciation on the building piece. So from a revenue point of view, I don't know whether their money would be well spent focusing on residential property investors, apart from perhaps just looking at when the property was bought and when it was sold. At the kind of commercial or the property construction side of things, there is a lot of interest in that space. There's no shortage of construction companies that are struggling in the current climate, and businesses that struggle will tend to pay the IRD last, and it is often the IRD that will pull the trigger and kind of enforce liquidation proceedings to occur. We've got a few construction businesses that are we're acting as liquidator for at the moment, and it's just hard because it's off the back of some pretty challenging times, high interest rates, the market's flattened, and they're carrying a lot of costs that they just can't continue to carry.
Yeah, and it's a real shame for the tradies and contractors that often have priced very sharply to win the work in the first place, and then don't end up getting paid in the end.
Yeah, it's a really unfortunate domino effect that happens. You end up with the large developers that fall over, and you watch the small businesses where that was a really big contract for them to have not come to fruition, and it's sad to see, because there are real people, real businesses, real lives that are impacted from these failures. But it is also, unfortunately, part of the economic cycle, and we're kind of right at the bottom of that cycle at the moment.
Yeah, and if we take that approach and say, for example, you are an affected party to a much larger liquidation, maybe you own a small trader business, blue collar, and you can't afford to sustain your current entity. How do you avoid getting caught up in a related party kind of phoenixing type arrangement where your one business hasn't worked out, you're falling behind, you want to continue to own your own business, you're going to set up again? What are the kind of mistakes that most people make when they're doing things like that?
Well, I mean, it's a tough space to be in. I mean, we've got a particular insolvency component in our business. I don't operate in that space, but that is the kinds of questions that are hitting them on a daily basis at the moment. There are valuable businesses with good kind of IP that sits in behind it. They've got good trading history, and they've been caught up in a something that is not going to work long term, where they've got too much owed to them by a failing business, and they need to restructure so that they can fight another day. Phoenixing was very popular and very common a number of years ago. I know there have been changes in the Companies Act kind of restricting what that could look like, so that you can't just bury a company one day and do the same thing under a new name the following day. There are rules around that, but I'm not the right person to kind of talk about the details there, Andrew.
It's evident that a lot of people are thinking about that at the moment, I'm sure. IRD's increased their budget, 2,000 audits a year previously, now increasing that up, major audits to 3,600 by the looks of it. If people are getting letters from IRD or getting somebody knocking on the door, investigations coming, audits coming, what steps should they be thinking about?
Yeah, they need to be engaging with their accountant, their tax advisor, for sure. The worst thing people can do is ignore the demand. It's not going to go away. So communication becomes your friend. I've got an example at the moment where a client has just kind of ignored responsibility, trying to focus on fighting today's fire and just moving ahead, and it's resulted in a significant amount of unfiled GST returns. IRD got sick and tired of asking. They just went straight into the bank account, pulled $50,000 out of it immediately, and they have the ability to do that. And it's quite scary to know that they can just tell the bank, we're taking the money. And for that to happen, it came as a complete surprise to the client, and it prompted action, understandably. But communication, 100% the best thing. So for those that were in trouble when COVID happened, there were some really good discussions that were being had with the Inland Revenue, who were very open to negotiate either repayment plans or a kind of revised lump sum settlement arrangement. The appetite's not quite the same as what it was then, because they were given the mandate from the government to not bury businesses. It wasn't the right time in the economy to do that. I don't know whether that appetite's still there, but you still need to communicate. If you don't communicate, you're doing yourself no favour whatsoever.
Yeah, and it certainly seems that IRD is encouraging people to refinance to pay these tax debts off. They're looking at the whole picture for the business or the private parties that are impacted and saying, look, you've got equity elsewhere. It's time for you to refinance, free up, and pay off the debts. So if people are looking to refinance or change the way that they're cash flowing their business, what are the considerations there?
Well, I mean, I guess ultimately you need to determine what is your exposure, because if you are a director and the tax that you owe is trust monies, then the IRD could go after you personally, as perhaps trading insolvency or insolvently or being negligent, and you don't want to be on the end of those proceedings. So you do need to consider what assets can you liquidate and what would that look like, or what that refinance look like. If you're refinancing or borrowing to pay down the tax man, then you'll want to be thinking about how can I get an interest deduction for any costs that I incur. Assuming that you'll get a deduction's not right, you just need to again take advice and review that, because that could make quite a big difference. If you're borrowing at say 6%, if you can get a tax deduction for that, then your actual cost of borrowing is only 4%. So it does make a big difference.
And I see that crypto users, IRD's calculated around 227,000 crypto investors in New Zealand, trading around 8 billion in crypto. If you have meaningful amount of crypto in your personal or business holdings, what are the tax considerations you should be thinking about?
Crypto's obviously exploded, and it's kind of been sitting there for a while, but the value went up. It's come back a little bit, courtesy of some political movements across the other side of the world. But there's a lot of wealth that sits in there, and there's a lot of caution by people who hold that wealth about what they do with it. So the idea came out a little while ago saying, hey, if you sell crypto and you make money, that's taxable, because people perhaps were thinking it was a capital gain and outside of the tax rules. So the IRD just said, that's not our view, and if we see it, we'll be taxing it. In the same way they came out a number of years ago in relation to gold and said, well, gold is exactly the same thing. You're not ever going to earn any income from it in a in a regular sense, apart from when you realize it. And that is not a capital gain, that is subject to tax in the Inland Revenue's eyes. So crypto, obviously a relatively new type of asset, type of investment. I think people just need to be sensible about it, like assuming that no one knows what's going on is going to get you in trouble. I've had conversations with friends, with clients who are sitting on quite a significant level of value from the rise of crypto, and they're starting to talk about leaving the country to realize that those funds and what that might look like, which becomes a little dangerous to start exploring those options, because if you actively avoid your tax responsibilities, that's actually tax evasion, and tax evasion can come with a criminal conviction. So it's a serious issue to contemplate. So again, you need to be taking appropriate advice, and just understanding what your responsibilities are.
A reminder, every video on this channel is a tactical edge. If you own property, want to own property, or just hate falling behind, subscribe, or keep losing to people who already have.